The mid-2020s present a fascinating, if challenging, landscape for economic theory. Global events, technological advancements, and evolving societal priorities are stress-testing long-held doctrines, forcing a re-evaluation of how we understand and predict economic phenomena. This in-depth story will explore how various economic theories are playing out in the current environment, supported by recent data on inflation, unemployment, and GDP, the specter of stagflation, a neoclassical challenge. For decades, the consensus in mainstream economics held that a trade-off exists between inflation and unemployment. As described by the Phillips curve, lower unemployment generally leads to higher inflation. However, the period of the early 2020s, heavily influenced by the COVID-19 pandemic and subsequent geopolitical events, has presented a complex picture. Data snapshot: global inflation. While peaking in late 2022 at nearly 9%, global CPI inflation had roughly halved to below 5% by late 2024. Projections for 2025 show it averaging lower than 2024, though remaining above 2010's levels. The OECD reported headline inflation at 4.7% in January 2025. Global unemployment. The global unemployment rate was 5.1% in 2023, with the OECD reporting it broadly stable at 4.8% in January 2025, a record low since March 2023. Global GDP growth. Global growth is projected to weaken to 2.3% in 2025, a significant downgrade from previous forecasts, with a tepid recovery expected in 2026 to 27. The EU's GDP growth is projected at 1.1% in 2025. The neoclassical lens and its strains. The persistence of relatively elevated inflation alongside historically low unemployment rates in many developed economies presents a puzzle for a rigid Phillips curve interpretation. While inflation has cooled from its peaks, it hasn't necessarily retreated to pre-pandemic levels despite some signs of economic slowdown. Supply-side shocks. Neoclassical theory acknowledges that supply shocks can cause both inflation and reduced output. The recent past has seen a confluence of such shocks. Geopolitical conflicts. The ongoing conflict in Eastern Europe has significantly impacted energy and food prices, a classic supply-side inflationary pressure. Supply chain disruptions, lingering effects of the pandemic, and localized disruptions continue to affect the availability and cost of goods. Trade protectionism, increased trade barriers, particularly tariffs, are identified as a significant upside risk to global inflation in 2025. This directly challenges the neoclassical ideal of free trade leading to optimal resource allocation and lower prices. Wage price spiral concerns, while not fully materializing, as a sustained spiral. The tight labor markets and robust wage growth in some regions have certainly contributed to inflationary pressures, aligning with neoclassical views on labor market dynamics. However, the data suggests that wage growth, while robust, hasn't spiraled uncontrollably into hyperinflation. Fiscal policy's role. Neoclassical economics emphasizes the importance of fiscal discipline. The large fiscal stimuli implemented during and after the pandemic, while intended to support demand, are seen by some as contributing to inflationary pressures by injecting too much money into the economy. The data showing stable government net lending, borrowing as a percentage of GDP in Indonesia, for example, points to varying fiscal stances globally, which influences inflationary outcomes. The data nuance. While the Phillips curve might not be perfectly flat, the current situation suggests that other factors, particularly supply-side constraints and policy choices, are exerting a stronger influence than a simple demand-pull inflation narrative. This has led some economists to argue for a more nuanced approach, acknowledging the limitations of purely demand-side models in a world of significant supply disruptions. Keynesian interventions and their aftermath. Keynesian economics advocates for government intervention to stabilize the economy, particularly during downturns, through fiscal and monetary policies. The response to the COVID-19 pandemic saw an unprecedented scale of Keynesian-style interventions. The Keynesian lens in reality. Fiscal stimulus. Governments worldwide enacted massive spending programs and provided direct aid to individuals and businesses. This aligns perfectly with Keynesian prescriptions to boost aggregate demand during a crisis. The rapid recovery in employment and GDP in many economies after the initial pandemic shock can be partly attributed to these interventions. Monetary policy. Central banks aggressively cut interest rates to near zero and engaged in large-scale quantitative easing. This too is a core Keynesian tool to stimulate lending and investment. However, the prolonged period of low interest rates in QE also contributed to the inflationary pressures seen later. The exit strategy challenge. A key challenge for Keynesian policy is the exit strategy. How to withdraw stimulus without triggering a recession or runaway inflation. The current attempts by central banks to raise interest rates to combat inflation are a direct consequence of the previous expansive policies. The aim is to cool demand and bring inflation back to target, albeit at the risk of slower growth or even a mild recession. The projected slowing of global GDP growth in 2025 suggests that the tightening monetary conditions are having their intended effect on demand. The data broadly supports the initial effectiveness of Keynesian measures in averting a deeper economic collapse during the pandemic. However, it also highlights the inherent difficulties in fine-tuning such interventions and the potential for unintended consequences like inflation, forcing a reevaluation of optimal policy timing and magnitude. The behavioral twist. Beyond rational expectations, traditional economic models, particularly neoclassical ones, often assume rational economic agents who make decisions based on perfect information and so on. However, recent events and the rise of behavioral economics challenge this assumption. Behavioral economics in action, consumer sentiment and inflation expectations. Consumer behavior, driven by perceptions and expectations, has played a significant role in inflation. When consumers anticipate higher prices, they may demand higher wages or accelerate purchases, creating a self-fulfilling prophecy. This aligns with behavioral economics, emphasis on cognitive biases and heuristics. The rapid increase in cost of living, particularly for low-income individuals, as highlighted by the OECD, can trigger such behavioral responses. Fear of missing out and asset bubbles. The period of ultra-low interest rates saw significant asset price inflation. This can be partly explained by FOMO and herd mentality, where individuals invest based on the actions of others rather than pure rational calculation, leading to potential bubbles. While not directly detailed in the provided data, the broader economic context of the mid-2020s has seen discussions around these phenomena. Labor market dynamics and quiet quitting, the Great Resignation, and the more recent phenomenon of quiet quitting reflect shifts in worker preferences and priorities beyond purely wage-driven decisions. Factors like work-life balance, well-being, and social purpose are increasingly influencing labor market dynamics, suggesting a deviation from the perfectly rational, the varying unemployment rates for men and women, and different age groups in the OECD, can be further analyzed through a behavioral lens to understand underlying preferences and biases. The data reflection, while direct data on behavioral biases is harder to quantify in aggregate economic statistics, the observed shifts in consumer and labor market behavior suggest that incorporating psychological and sociological factors is crucial for a complete understanding of economic trends. This strengthens the case for behavioral economics to gain further prominence in economic modeling. The rise of AI and the future of productivity, a new frontier. Artificial intelligence is rapidly emerging as a general-purpose technology, with profound implications across microeconomics and macroeconomic levels. Its impact is still nascent, but is already prompting new considerations for economic theory. AI's economic implications. Productivity growth. A key economic question is whether AI will significantly boost productivity, potentially offsetting inflationary pressures and driving long-term economic growth. AI's ability to enhance individual decision-making, efficiency, and optimize corporate management aligns with this potential. Labor market transformation. AI's impact on the labor market is a subject of intense debate. While some jobs may be automated, new ones will likely be created. Understanding the skills gap, the need for reskilling, and the potential for increased inequality due to AI is critical. The Human Capital and Labor Market Policies Index for Indonesia hints at policy responses to such transformations. Industrial organization. AI is transforming industrial structures, fostering new business models, and creating new growth drivers. This will necessitate re-evaluating theories of market structure, competition, and innovation. Economic modeling. AI is already changing economic modeling, offering improved forecast accuracy, the ability to process large data sets, and real-time analysis, complementing or even replacing traditional econometric techniques. This directly influences how economic theories are tested and applied. The data challenge. While the full economic impact of AI is yet to be precisely measured in broad macroeconomic data, early indicators and qualitative observations suggest a significant disruptive force. Traditional economic theories, particularly those focused on production, functions, and labor markets, will need to evolve to fully incorporate the unique characteristics and rapid advancements of AI. An eclectic future for economic theory. The mid-2020s reveal a global economy in flux, challenging the neat categorizations of economic theory. While neoclassical principles still offer valuable insights into market mechanisms and efficiency, their limitations become apparent when confronted with persistent supply shocks and the complexities of human behavior. Keynesian interventions proved crucial in crisis response, but highlighted the challenges of managing their long-term consequences. Meanwhile, the rapid ascent of AI introduces a new layer of complexity, demanding a re-evaluation of fundamental assumptions about productivity, labor, and market dynamics. Moving forward, economic theory is likely to become more eclectic and interdisciplinary. The emphasis will shift towards integrating behavioral insights, Understanding and modeling non-rational decision-making will be crucial for accurate predictions and effective policy design. Developing dynamic models for supply shocks. Traditional models often struggle with unpredictable and persistent supply-side disruptions. More robust frameworks are needed, accounting for technological disruption. The economic impact of AI automation and other frontier technologies will require new theoretical constructs and empirical policy, nuance, and adaptability. Policymakers will need greater flexibility and a deeper understanding of the interplay between various economic forces, moving beyond rigid adherence to a single theoretical framework. The data from 2023 to 2025, with its mixed signals of cooling, inflation, resilient growth, and tight labor markets, is not a simple validation or refutation of any single economic theory. Instead, it serves as a powerful case study for the evolving nature of economic reality, pushing economists to refine, adapt, and integrate diverse theoretical perspectives to better navigate the complexities of the 21st century. Global economy.